Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Vizsla Copper.
Junior woes will continue into 2024. This is Paul Harris for Kitco Mining at the Precious Metals Summit in Zurich, Switzerland. Joining me to discuss this is John Feneck, founder of Feneck Consulting. John, welcome to Kitco.
Thanks a lot, Paul.
I know you've been a Kitco contributor before, but why don't you refresh our viewers, what is Feneck Consulting?
Oh, sure. So we started about 4.5 years ago. We do some consulting for some commodities companies, but we also have been running money since January of 2016. That means my own money. And our track record is posted on feneckconsulting.com. And we're very proud of that because we try to grind every single day to generate outperformance above what we consider our benchmark, which would be GDXJ. This year, we're about 600 basis points ahead year to date through September 30. But I think there's going to be a lot better opportunities next year. And that's what I'm excited about. And that's how we're positioning right now is for next year.
We had a great conversation about this as we're preparing for this recording. So hopefully we can capture a lot of that in the recording. What are some of your key takeaways from this week here?
Sure. I think the access to capital for juniors may be more stretched next year because we have been in a downturn, let's face it, since the summer of 2020, right? So after 3.5 years, I find that investors are getting a little less willing to invest in mining companies through something like a private placement. But they also... but also the headwinds there that I see next year are sort of the geopolitical type, right? It's like Mexico, if we had this interview 2 years ago, was a great jurisdiction. And then we saw what happened with First Majestic and their issues. We also saw what's happening now with VAT payments to any company, not just mining companies. The Mexican government's just been very stubborn about giving any of that money back. So it's deterring investment there, yet we have 90, let's say, silver junior companies in Mexico alone right now, many of which are not even close to profitable, right? So we have to see a consolidation, I think, in the industry. That's also being talked about by Jamie Strauss and some others here at the conference, that we need to see, some type of consolidation. And we saw some of that this week with the Marathon deal. We'll just see how things play out. But hopefully those consolidations are done in a prudent manner, meaning that the shareholders of these companies are going to get a payday because, it's been a really rough run here. Let's be honest, for 3.5 years. Investors don't invest in the junior space for 10 to 20% gains.
I mean, is it a complete sort of investor capitulation? They're exiting the sector, period, or just exhaustion with the current state of affairs? They're going to go and take a sabbatical and wait for things to improve?
That's a great question. I really don't know. I'd say it's more of the former, from the kind of volume that I'm seeing in certain juniors, the kind of selling that would indicate to me more of a market order selling than an organized selling, where you just put up a bit, an ask out there at a certain price and let people, try to buy into that. There's just selling, broad sell, like, maybe 500,000 shares of a junior, in an hour or something like that, which is crazy. So that's why we coach our clients and our followers to put 2 buy orders out there. One close to the action if you really want to get a position, but also one that's 7 to 10% away from the action. And that worked for us even this week.
Do you see the potential that the junior space is getting into a downward spiral? You mentioned something that's getting increasingly difficult to raise equity. It's getting increasingly expensive to raise equity. There's fewer people to raise that from. And so things will continue to deflate.
I think next year we're going to see some love in the gold sector within the commodities world. And by that, I mean gold will make a new all-time high, which is a new kind of outlook from us. We've been very guarded on gold for people that follow us for at least the last couple of years. We have said this year that the price being above $1,900 an ounce for months in a row with no down days below $1,900 is extremely bullish. So I think what's happened, Paul, is you've seen a new floor put in on something like gold as a result of the financial crisis we saw in March and as a result of the Israel conflict October 7th. And we had our best subscriber growth month in October ever. So we're seeing a lot of people that are generalist investors, is what I mean, coming to us and saying, I'm not a gold and silver person by trade, but I see the need to hedge what I've made over the last 14 and a half years in this bull run. Help me understand how to do that.
We talked a bit about investor capitulation, but what about management capitulation? It must be very difficult as a manager of a junior explorer facing this situation month after month, day after day, year after year, for a couple of years now, 3 years maybe. Do you see capitulation, signs of capitulation in the management teams themselves? They're just given the ghost. They no longer want to just grind it out every day and try and make things better for their shareholders.
Absolutely. I mean, that's why we use a rifle approach in this market right here. We were talking off camera about when you don't need a rifle approach, which was like Q1 of 2016, right? GDX and GDXJ had both reached ridiculous short levels in December of 2015. They were both over 20% short as ETFs, which is insane. So when you see that kind of short interest out there, it's got to get covered if we get a rally. We saw that rally start in late January of 2016. It then fed on itself. It attracted new money. And then by August of 2016, it was over. But those two ETFs were both up huge multiples. And I don't see that kind of a euphoric move this time around, but I would say we're getting really close to a move that looks very positive here to me, especially after looking at the core CPI number yesterday at a 2-year low, and then UK news just came out and they have a 2-year low as well. So, I mean, that for us is meaningful. We've been on Kitco since last spring talking about the fact that inflation was going to be higher for longer, that rates would be up higher for longer. None of those things benefit what I do. We're just trying to educate investors on what we saw to say that it was going to be a longer road to where we are right now.
There seems to be a lot of good value out there in the junior space. What is it you're looking for, and what do you want to see in the management teams beyond having a great deposit?
Sure. We want to see experience in the management team. Almost every junior we invest in, the CEO has been in the business 25 plus years. So they've seen 2000, they've seen 2008, they've seen 2015, right? They've lived through cycles where they've had to pull in their belts and understand how to survive. That's part of the key right now, is survival, unfortunately, for some of these junior companies. We also want to see that you're cashed up right now, right? I mean, that would be a positive. Having some cash in the bank is not a negative right now. It's going to be difficult to raise capital next year, as we talked about. We're also, of course, looking at drill results. I was just talking to Rob McEwen, and we were talking about how drill results at companies, Goliath, Hercules, some really nice hits, and the market is responding for the first time in months, which is positive. So those are just a few of the things we look for, but we also look for jurisdiction. Jurisdictional risk has increased immensely over the last 2 years. So we're trying to deploy capital into places that will have less risk.
Okay. You've mentioned a couple of times during this conversation about educating your subscribers or your investors. And we talked off camera, that includes educating people to take losses on some investments to benefit from the opportunities that come up. I mean, that's a tough thing for people to do, to take losses and admit a failure or crystallize a failure.
Of course. We just operate from the perspective that people have a limited amount of capital that they want to deploy into our sector, right? So if that's the case, you need to be honest with yourself and look at your holdings and say, is this portfolio positioned more for 2020-21, or is it positioned for what's happening next year, right? And many times it's positioned in the past. Many of those companies aren't what they used to be. Management changes, drill results that haven't impressed, you name it. So you have to take losses. It doesn't have to be at this time of year, but take some losses in the portfolio and redeploy that capital into names that have a better chance for success in next year.
Do you see that a lot, that people have a portfolio that was right for yesterday, but is no longer right for today and certainly not right for tomorrow?
I see it every week, yeah. And so it is something that, look, everyone has a hard time admitting they made a mistake, but sometimes it's not your fault, right? I mean, I remember talking to a junior last year, and 3 different times they didn't tell me the truth and then they went bankrupt, right? So I can't protect against that kind of activity. Thankfully, it was a small position for us. as we talked about off camera, to us, it's not only what you buy, but it's what you avoid that really helps generate success over time.
Well, talking about people that are avoiding things, despite the fact share prices are low and the values are potentially very high, why aren't more bigger companies buying smaller companies?
That's a great question. I mean, just looking at history, it seems like the majors are always late to the game, and this time will be no different, in my opinion. When gold breaks to a new all-time high next year, you're going to see a lot of deals being done. Hopefully they're going to be done, like I said, at reasonable prices for those investors in the junior or mid-cap space, because they have suffered a lot. And so you want to be able to, I would just add that, you want to add to those positions right now if you think that those small and mid-cap names would have the potential for a takeout in 2024 or 2025 to lower your cost basis. Just buying once and crossing your fingers is not a strategy. You have to buy, for us, anywhere between 4 and 10 times on any junior stock, and we continually add to our positions where we have conviction. One thing we do differently, Paul, is we call CEOs literally all the time. I mean, I'm on the phone with 10 to 15 a week. A lot of people like that because they're doctors, they're lawyers, they're construction workers. They don't have time to do this themselves. So that information we then, send out to clients via email and just talk to them about, hey, we were at this conference in Zurich. Here's what so-and-so said about their drill results. So we're talking about public information, but, directly from the CEO, within 24 hours.
I think that's an interesting point you make. Picking a winner, identifying that winner, let's say 12 months ago is one thing, but the game changes and, the share price falling, you're out of the money. So even if there is a takeover at a premium, for you, it could be a take under, you're losing money. And I detected there was a big transaction announced this week in the mid-tier, and a lot of people, I think, were unhappy with it for that reason. They got the result they wanted, but not at the price they wanted, and so they're actually losing money with the deal.
Exactly. I mean, I think you're referencing Marathon.
Yeah.
Marathon, we started a position at 0.40 just a couple of weeks ago, and the deal was announced around 0.461, I believe. So, again, what's your upside there? I think the deal price is 84 Canadian, so that's about 61 US. I mean, not what people are looking for, considering most people probably entered the stock way higher than that.
Yeah, because a couple of years ago it was a $3 stock.
Yes.
Okay, so what would you say is a healthy investment strategy for people right now?
Is to partner with someone like myself. It doesn't have to be me, of course. Just anyone in the sector that can guide you a little bit is going to be helping you immensely, because we're at a point now where things are so cheap that you could just probably you could probably do okay on your own right now because things are so cheap. I wouldn't say that a year ago, but you still want to understand. One of the things I see that clients do without knowing it is they'll construct a portfolio, and then I'll say, okay, so tell me how this is broken down between gold, silver, copper, PGMs. They'll have no idea. They don't even know. They just see interviews like this. They buy a name.
No structure.
Yeah, and that is important to know your exposure, right? So if gold moves, if you only have 10% of your holdings that are in gold juniors, you're not going to get that kind of alpha that you want out of your portfolio. So just, talk to people in the industry like myself about, here are my goals, here's how I want to construct the portfolio, and make sure that you're positioned properly.
Now, you mentioned you expect the ability of juniors to finance next year to get more difficult. What else do you think will happen next year, and what else would you like to see happen next year?
Well, I do think on the negative side that jurisdictional risk will continue to be a problem. I think permitting in certain parts of the world will continue to be a problem. On the positive side, if gold breaks to an all-time high, silver is going to narrow that gap. Right now, as we sat here before CPI yesterday, I haven't checked today, but we were at an 87 gold to silver ratio, which was a price of an ounce of gold divided by an ounce of silver, and that ratio, whenever it approaches 90, Paul, is almost always a buy on silver and silver equities going back to the 1980s. So we have been buying more silver juniors over the last couple of weeks as a result of that. because silver hasn't broken down. If you look at the chart, it doesn't look pretty, but it hasn't broken. And so gold and silver in this kind of environment, and gold and silver equities next year should do very well. I don't think that this Israeli conflict is being taken as seriously by the broad market as it should be. When you hear, you can go through a laundry list of things here, but the players involved here are serious, and there's a lot looming out there that the average investor probably isn't doing homework on that I am, and we are positioned for more conflict, unfortunately, happening into next year. And I think that gold and silver have proven themselves over time to be a store of value and a way to protect or hedge a portfolio, right? So we have been overweighting our gold and silver equity holdings as a result.
Well, John, we'll definitely have to catch up at some point early next year and see how things are materializing. Thank you very much for joining us today.
Thank you, Paul.
And this is Paul Harris for Kitco Mining at the Precious Metals Summit in Zurich, Switzerland. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Vizsla Copper.